All right, good afternoon. This is John Cruz, and we're uh, demoing the October crop and livestock outlook today. We've got myself, Marty, and Scott Brown, who are going to be presenting today. And so we'll go ahead and get started. Please ask lots of questions today. We don't have quite as long a program today, but let us know if you have questions. It's going to kind of lay out what we're talking about today. So we've got a little bit more on the China trade war, talk a little bit about ASF and the new pork production numbers that are out from USDA, corn outlook, soybean outlook, the hay outlook, and a little bit on livestock towards the end of the presentation. So without too much delay here, I'm going to jump right into the China-U.S. trade war. So as you know, there's been some developments here over the past few days. It appears that there might be the framework for an initial agreement in play. It looks like, at least right now, we may have agreed with China that they're going to buy $40 to $50 billion worth of U.S. agricultural exports. That's exciting news for us. We have that will be a major increase for us in agricultural trade, and so you can see that as you look at the U.S. and Brazilian soybean pork prices, you can see they've reconverged back together here in the last few days. This is up through the 11th of October, so that's exciting to see that we're at least back on par with the rest of the world in terms of our prices, and so that's good news for us as crop producers. As we look, I wanted to remind you just a little bit about last time. You know, we were talking about the data that was coming out of China on the sow inventories being down about 33% or so. As we then now had, as you know, USDA updates their global livestock forecast usually in April and October. And so we've got new numbers now from USDA, and they are showing very similar numbers to the Chinese numbers that came out in July. So they're showing about a 30% decline in beginning stocks, in 2020 of sows, so which would correspond to December 31st of 2019. So being down about 30% on sow inventories. Notice the impact on production next year. So in 2020, they're showing a 25% decline in pork production. And one of the reasons that I'm a little bit concerned about that is I was tracking the data from the Feed Milling Association, and they were showing about a 14% decline in swine feed. But if you look at the other sectors, which were beef and poultry and the other meats, their production was up enough to offset essentially the decline from the pork side. And so they were saying net feed milling was really pretty much the same as the previous year. However, as we go into 2020, that additional decline year over year, down another 25% on the production side, concerns me that we may not yet have seen quite the full impact on feed demand of this ASF. And so that's one of the cautions that I throw out there based on the recent data that we've seen, is that we may still yet see a decline overall in demand. Now, of course, this is going to be interesting in the presence of if we do have a trade agreement that's going to boost U.S. exports that much to China. You know, will this come at the expense now of Brazil and Argentina's ability to export if the U.S. does in fact get in with that level of trade? So that'll be one to keep an eye on. So with that, I'm going to turn to the corn outlook, and we'll let Marty run it from here.
Okay, so I got a few bullet points here. You know, since the last meeting we had, we've had a couple of reports, and maybe even more significant than the report that we got last week on the production and supply demand update was this September 1 stocks report. So this came out at the end of September. As of September 1 stocks, so essentially USDA, that 7.1 number becomes the old crop carryover for stocks, and that came as a pretty big surprise to the trade. The 7.1 stocks came in about 300 million bushels lower than the trade expected, and so we saw a pretty big price response from that. And it's a little bit of a game changer in that stocks number was quite a bit tighter. We'll talk about some of the implications of that in terms of the balance sheet here in a minute. As far as the production estimates, pretty small revisions for yield and production this month. One of the things that's going on now that's been supportive to prices is the weather. We've had blizzard conditions up in North Dakota, and then a lot of cold, freezing type temperatures this morning down as northern Illinois. So probably some impact on the crop there. Less positive on the demand side is we've been facing pretty sluggish exports. USDA reflected some of that in the revisions, and corn for ethanol has been fairly soft. And I think as we get to moving forward here through the fall, South America's crop outlook will become more important to how our prices react. Here's the supply-demand balance. You can see that that column 2019-20, the current yield, they actually nudged it up 0.2 of a bushel from last month to 168.4. The trade was leading down on that number a little bit, about a bushel and a half or so. That was a little bit of a negative surprise. Trade looking for a bigger cut in the yield of production. However, that beginning stocks number there, 2.114 billion, that's quite a bit smaller number than the USDA was carrying on their balance sheet prior to that stocks number coming out. So again, about 300 million bushels lower than the trade expected. So kind of have a offset there with supply still down. I guess we've got total supply up a little bit. I guess the implication of the stocks report is that the feed and residual there, that kind of that yellow circle, they revised the 2018-19 feed and residual up over 300 million bushels, and then that carried over into the current crop year as well, boosting that number up to 5.3 billion. However, going down through the balance sheet there, they cut the corn for ethanol, and then also cut exports down toward the bottom of that table, down 150 million from last month all the way down to 1.9. So now we're looking at carryover close to 1.9 billion, a little more positive situation. So we got to carryover down at 1.9 billion. Tightening a little bit from last year. USDA also did revise the price forecast up about 19 cents year over year to $3. Well, they revised it up 20 cents from the previous forecast. It's up 19 cents from last year. So I think the implication of the balance sheet here is that if we were to see some reduction in that yield and production, it wouldn't take too much tightening there, or it wouldn't take much of a reduction to see these ending stocks tighten up fairly significantly. So I think that puts us in a little better position as far as the market responding if we do see a further cut in the production estimates, or we do see some say weather threats in South America. Speaking of South America, so this is a USDA's data on Brazilian production, Brazilian Argentine production. I've got them both here on this graph. So the blue bars would be Brazil. Currently, Brazil's projected to be about steady with last year at 101 million metric tons of production. Argentina down just a million tons from last year. So obviously pretty early in the season. We can't put a lot of emphasis on this at this point, but at least starting out looking for production pretty high and down just very slightly from last year. That red line on there is their combined exports. So it looks like currently down about 7.5 million tons on their export forecast from a record last year. And so that large export out of South America is one of the reasons USA is a little negative on our export projections for the U.S. Here's our exports. You can see their projection this year, 1.9. So down pretty significantly from the last few years when we were flirting with close to 2.5 billion on exports for corn. And we're off to a really slow start for exports. The export commitments thus far, we're down by, say, half what we were last year. So you look down through some of the big exporting, some of our destination countries. So Japan, Korea, Mexico, they're all down pretty sharply from this time last year. As far as the yields go, USDA revised their yield up a little bit, just fractionally from last time, but we're still down year over year. As far as Missouri goes, actually saw a pretty big revision down for Missouri, down 5 bushels. That was the largest downward revision of any of the major production states here in the U.S. So 5 bushels down to 155, and that compares to 140 bushel yield last year. Corn production, again, just kind of creeping down from last year. Still relatively large crop. We look at the stocks to use, so things are tightening up a little bit. I wouldn't call this necessarily, sort of stocks tightness, but up there around 13.5% stocks to use. Reading off that right-hand side of the graph. But again, if we were to see some further reductions in the supply side, or if maybe the demand does pick up a little bit, say exports are now underestimated, we could tighten things up, especially if you were to see this down closer to 12, 11, 10% stocks use. That's when the market begins to respond to that kind of tightness. One thing I wanted to mention about is regarding the funds position. A lot of the market talk kind of centers around what the funds are doing, and we've had quite a bit of impact on the market based on fund activity. So if you look back there to that blue shaded area, back in the spring, funds were net short over 300,000 contracts at that point. And then once we got into the weather situation and started to move prices higher, they covered that position and actually moved a net long, not quite 200,000. So we had a 500,000 contract swing in the funds position. And that moved prices, that red line, moved prices up over $1 a bushel during that period. So then subsequently, we had the peak, we got through the weather issues and prices pulled back, and the funds moved from net long to back to net short. I think close to 150,000 contracts. And then more recently, they've been covering that position. The most recent report had a net short about 91,000. And so that short covering, I think, is contributed to this recent price strength that we've seen out of the market. That red line there is tracking the nearby futures contract. Another thing I wanted to point out is December 2009. So 10 years ago, we had a real similar kind of price pattern in the corn market. The high back there in June, prices moved lower into early September, and then saw a pretty good rebound. That timing and sort of the extent of the up move and the down move into September, then kind of in this recovery phase, looks a lot similar to what the current December futures contract looks like. If you look at the March 2010 contract, we pretty much went into a sideways pattern there toward the end, toward that a little above $4 on out to after the first of the year. Then the January production report in 2010 was pretty negative, and prices sold off from there on into the spring. So here's the current price pattern. Seeing prices there high in the early summer down into September, then kind of in this recovery phase, prices kind of flirting with the $4 mark. I think from here, we've got a little bit of a headwind, of course, with a lot of the harvest still ahead of us. You know, if the futures market can kind of hold together here, we get a little more optimism, say, with the trade issues. It'll support, you know, with the soybeans helping some. I think retracement back up towards about 420 or so looks pretty doable for the market here over the short term, but probably wouldn't expect a whole lot more than that out of it. That would be a little short of the kind of recovery that we saw in 2009, but I think something that's reasonable between now and say, you know, late October, early part of November. So we got the harvest pressure near term. We expect some post-harvest recovery, particularly in the cash market. We've got the funds helping support the market. We are tracking close to that 2009 pattern. So that would point us a little higher, you know, kind of on into late fall, early winter. The basis in the futures, so we've seen a pretty strong basis in the corn market so far this fall. We've gotten some decent demand out of the southeast, for example. The basis levels across the sort of the eastern half of the Corn Belt particularly have been pretty good. You know, we had the late harvest, which is, I think, also contributed to a little stronger basis. The futures carry has eroded a little bit with this up move in the futures market over the last month or so. So the carries in the futures are not quite as favorable as they were, but there still may be an opportunity to take advantage of that carry in the futures by selling, you know, something, you know, after the first year, maybe out there to the March or May contract as a possible hedge. I think, as I mentioned before, with this stocks report, and if we do see some further tightening to the balance sheet here, I think we're in a position where we will get market reacting to some South America and weather threats if they come about. You know, right now, crop down in South America, kind of in the early stages of planting. I think Argentina's about half done with their planting. They kind of go in two phases. They plant about a third of the crop early, then they kind of pause through about this time period here in October, and then they kind of ramp it up again in November and early December, plant the rest of the crop to kind of as a way to kind of avoid some of the worst part of the summer heat there. So we're kind of in that middle phase right now in South America. A little bit of dryness in the west and southern parts of Argentina at this stage. Brazil, similarly, only about 10% planted overall, but the southern regions of Brazil have been planting more or less on time. There's been some concern about dryness in Mato Grosso, which is where they do a lot of the double crop with soybeans, and then corn after that. So a little bit of maybe lateness, a couple weeks late planting some of those beans. So that'll be something to keep an eye on as far as Brazil goes, but way too early to draw too many conclusions about that at this point.
Okay, so on the soybean side, I'm going to start right off with the old S&U table here. First thing is was the revision down in soybean yields about 2.1% from last month. So a little weaker yield, giving us just a little bit weaker production. So down almost 100 million bushels altogether on that. And then we also had a revision in beginning stocks. So by the time you put those two together, you know, you're at 175 million bushels less supply in the pipeline. So that when you look at that, there's really not much change in the demand side. A little bit higher crush. Exports pretty much the same. So when you drop all that through to the bottom line, now all of a sudden we're talking about ending stocks at 460 million bushels. Significantly lower than where we were just a few months ago. So that's given us some support on the price side. About WASDE has updated their range, or USDA, to be 50 cents a bushel higher. So they've got $9 a bushel out there as the projection for the season average farm price. So that's some good news. I think coming in, both corn and soybeans being weaker on the beginning stock side, a little more use than we expected to get last year, so that bodes well for prices, and so some good news there. Now, started off this season, we are in a little bit weaker spot, but it's interesting where that weakness is coming from, because for a change, it's not all directed at China. Of course, China's not as good as it has been, but it's better than last year. And so that's still fairly positive in terms of our accumulated exports and outstanding sales to China. So, and if we look at year to date, this time last year, we hadn't even sold 50 million bushels of soybeans to China, whereas this year we're already up at about 175 million bushels. So still a little bit of a far cry from the usual of 425 million bushels, but we'll see how that catches up here over the course of November and so forth. So one of the ones that I did want to point out here that is kind of interesting is, though, right now we're not showing any outstanding sales or exports to Mexico. So that's one we're going to have to keep an eye on and see if those reemerge, or if they're going to lag significantly behind other years. So that's one to kind of a note of caution there. They really didn't make a lot of changes in the outlook for Argentina and Brazil on soybeans. Pretty much the same planted area as they had before. Of course, that is in process right now. Beginning stocks in Argentina, they revised those down just a little bit, about 36.7 million bushels. But in Brazil, they revised that one up about 23.5 million bushels. So on the net, there's really not a lot of change there. In Argentina, a little bit of a reduction in crush, about 1 million metric tons, or 36.7 million bushels. And then ending stocks being increased by 31.2 million bushels in Argentina. Similarly with Brazil, the extra additional carryover flowing through into stocks, but by and large, a little bit of a tick up in the feed residual category. So both Argentina and Brazil showing an increase in ending stocks projected for the 2019-20 market year. What this means for soybean prices, well, since the report was released, we bounced up about a little over 20 cents a bushel. And I extended this one so that you can see a little further back. We still aren't quite back up into where prices were back in early February. And if we went on back into December, we wouldn't even quite be as high as those were. So what I'm going to say about pricing opportunities, keep an eye on this. If we start to get movement from China and they start to buy a lot of soybeans, which could be a very strong possibility, you may see these prices edge up a little bit higher. And it's certainly if they get much above $9.80 or even $10, it's a very clear signal that we probably ought to be selling some of the 2020 crop. If we haven't, and also pricing some of the 2019 if that's not fully done yet. So those are some triggers that I keep an eye out for. This is a little bit more of an optimistic discussion than perhaps we had last month, so that's good. And I would say, as you look at what's kind of added up here, really the downward revision in supply, beginning stocks, yield, and production, really right now, no change in export projections, but we could see that edge higher with this new trade deal. There is the biggest negative I see kind of on the horizon is really with respect to Chinese pork production. It could be signaling that maybe we'll get into some weaker soybean demand in the future, but it may be that depending on the trade agreement or how that works out, it could be that Argentina and Brazil actually bear some of the heavier brunt of that. Market has been trading on the U.S.-China trade war, very much so. You can watch the pork prices and almost see the reflection between the gap in the U.S. Gulf price and the Brazilian price, and that's almost a clear indicator of whether the trade war is having an impact. Production changes have largely translated into lower stock levels, and as I mentioned just a second ago, watch for those opportunities to price if the futures get above $10 a bushel. And I certainly hope that can happen, but we'll see. So I'm going to turn it back to Marty, and he's going to talk about hay.
Thanks, John. Well, this will be just a few slides on hay, kind of a short discussion. I think last time we spoke about hay a couple of months ago, we have this graph and showing the May 1 all hay stocks in Missouri. You can see down lowest stocks number going back at least essentially 30 years, probably much longer than that. So tight hay supplies, that's not new news. But what has happened this past year is we've begun to replenish those stocks. We've had an uptick in acreage of both mostly what they call other hay, the stuff that's not alfalfa hay. So we've had an uptick in harvested acres this year. I think the big news is really this graph with the hay yield. So the highest yield we have going back to at least 1990, and they did revise this number up a little bit, up 3 or 4%, just from their August estimate. So they updated, put out a production estimate for hay in August, and then did an update here with the October crop production numbers. You can see pretty hefty recovery in Missouri's other hay yield. And so we've gotten a pretty big increase in production. Look at that total production number. We're up over 30% over a year. So a pretty strong recovery there. The gold bars are the other hay category. The black is the much smaller, of course, alfalfa hay total. So this should, I think, translate into larger stocks and a little bit of pressure on hay prices. We don't really have a real good series on hay prices. We'll see if we can find something that might be a little more relevant. We don't have, other than USDA mass data, which kind of lags quite a bit. Their most recent data point for the hay was flat, and that's going back to July. Anyway, with that, I'm going to turn it over to Scott.
So good afternoon, everyone. I'm going to do a little bit of livestock outlook for you. Start with just where we've been on a weekly basis with slaughter steer prices. So the good news is we've gotten some recovery after we got some cash prices that would have slid just a pitch below $1 a pound back here a few weeks ago, and really the bottom, given the Tyson fire that we saw, with prices moving higher and the strength again last week in terms of what we saw in fed cattle prices. I'll say, the current news on the export side here for beef probably hasn't been all that great in terms of where cattle prices are going, but the longer term certainly looks positive with some of the news we're getting of late. We'll see. We seasonally tend to see some moves higher in terms of fed cattle prices between here and the end of the year. So we'll see if that continues as we move forward. We're looking at those calf markets so far, 4 and 5 weight calves. Again, some strength showing in those markets as well. I will say it's nice to have reasonably priced feed. I don't know what was said as I missed the corn outlook, but cheaper corn prices certainly doesn't hurt the appetite that feed yards are willing to pay for some feeder cattle. And again, maybe we'll get some continued strength in those prices as we go through the remainder of the year. The hog side, it continues to be a balancing act that we're walking on with very large increases in production forecasts for this year, offset by what's continued interest in stronger exports of pork. I'll remind you all that as we think on that side of the equation for a minute, so for sure we're getting interest in what happens on the China market, but with ASF now in other Asian countries as well, countries like South Korea, that I think could really be helpful to exports of U.S. pork as we move forward. I keep saying we're going to be at one extreme or the other for hog prices. If you don't get strong demand and you have 4% growth in pork production, we'll be at the low end of the spectrum, because we're going to run. All right, so just so everybody understands, Last week or the week before, we slaughtered almost 2.7 million head of hogs for a week. That's very near a record, and we're far from the end of this year. So we'll for sure get a record in terms of slaughter. Thank goodness we have that processing capacity on board. We're pretty heavy on the supply side. So if we don't get a lot of trade strength here in the last part of the year, we could be at the low end. However, if the Chinese decide they want significant amounts of U.S. pork between now and the end of the year, it could be really good for barrel and gill prices. I guess as I look at the WASDE outlook, I'm going to stay more focused with you today on 2020 than 2019. I'd like to think now that we're setting in October of this year that USDA is pretty good at forecasting 2019 at this point. But for 2020, you know, the story is frankly not all that different than we've seen for a while. The 107 billion pounds of beef, pork, chicken, and other that USDA forecasts, you know, roughly is another 2.5 billion pounds of growth. I keep saying we're in this 2 billion club now because we've grown 2+ billion pounds of those meats for 5 straight years. That's pretty phenomenal when you look at it relative to historical standards, and we don't want to forget that's what we're doing. On the export side, though, USDA becoming more optimistic in 2020 as we move forward. Another 1.1 billion pounds of that 2+ of production that we are forecast to have in 2020 is going to leave the United States. Pork leads the way with a nice revision in the last WASDE data. I think another 250 million pounds was forecast for 2020 in the October WASDE relative to where USDA was in September. So more supplies. We need export strength to move that forward. On the price side, I just remind you, so USDA on barrels and gilts in particular, so $58 annual average barrel and gilt price for 2020 with 1.1 billion pounds more production. That takes demand strength. I'm not saying USDA is wrong in that. It did come down $1, I believe, from September to October, but that's you're betting a lot on some pretty strong trade to make those kinds of prices come in place. All right, so these are USDA's 2019 estimates for cattle and hogs. I like to remind us, and I'm not making fun of USDA in this for a minute, but if you look at what's been happening on the cattle side, after really in about February of this year at almost $1.20 fed cattle, USDA has been coming down every month. Well, you notice the volatility of the last few reports. The fire in the Tyson plant certainly had something to do with that, but you know, if you look at September where we were sitting at about $1.13.5, now back to a $1.15.5. We almost gained everything back that WASDE would have taken out in September with the October number. That's pretty amazing when we have so many months already out of the way in terms of coming up with that 2019 calendar average. On the hog side, we've been drifting a little lower for 2019. I should say USDA has been drifting a little lower for 2019. We've got several months in a row, and I think we got really excited about our ability to export pork to China and just didn't realize it, and that's made USDA continue to revise down. Just don't forget the other side can now happen in this as well with some potential news, I guess. I don't know what others have talked about today, but potential news of a big deal that includes, you know, some pork. I think it could get pretty strong for pork prices if we do, in fact, talk about some significant quantities moving. On the milk side, I keep reminding us that we're getting higher milk prices. We're in a much better place than we were a year ago at this time. But if you look at the decline, and it's been a supply side phenomenon that's happened. It's taken us a long time to turn the supply side of dairy off. And we've seen about 120,000 cow decline since January of 2018 in U.S. dairy cow inventory. But 2/3 of that decline occurred in the first half of the Jan 2018 to current period, and we've only lost about a third in the second half. So we're really slowing that reduction in milk production. And so now we need demand, I think, to pick up if we're going to keep moving prices higher. And so I'm a little cautious about where we go. I am not saying prices go lower in 2020. I think they'll be higher in 2020 than 2019, but I don't want us to get carried away in terms of what the message is out there. That if we start to talk about increases in dairy cow inventory again, it won't take too much, I think, to take the shine off of where we're at. We've got some pretty strong product prices sitting out there today, with cheese now over $2 for several of the last weeks of data that we have. Butter setting at 2.25. For me, it's hard to talk about those prices higher, especially when you look at where global dairy prices sit. So it's a nice change to be able to talk about a little better situation for the dairy industry, but I do not want to overemphasize the positive here, because we're just allowing folks to begin to slowly maybe try to creep out of some of the pretty gosh darn deep holes that they've dug for themselves over the last few years with the low prices that we have. We do see the increase in weekly shipments of pork to China that's occurring. We got some really good news last week out of that weekly trade data that would have suggested that China's going to take a lot of pork in 2020 as well. Realizing those sales and making sure that we actually have shipments like this data shows is going to be important in terms of what's going on. Again, as you look at 2019, so what's happening to the rest of the world, we've actually been dragging in terms of those shipments of pork to the rest of the world. Just a reminder of where pork sits as we think about trade going forward. So with that, I get to say thanks. Now I'm going to turn it back over to John so he can take questions.
Well, I hope you guys are thinking up lots of questions. I was going to add one note to the crops outlook, and that is, we didn't mention this, but there have been some interesting developments on the biofuel side with respect to small refiner exemptions, and the idea that some of those may be wrapped back into volume obligations to actually compensate the, if you will, the volume obligation for the fact that those exemptions have been given. There's a lot of speculation as to exactly what that's going to look like, and in the next few weeks we'll probably find out. But that may give us a little more demand support back on the ethanol side as well as on the biodiesel side, because indirectly those things feed through to the volume obligations on advanced and biodiesel on the advanced and biodiesel side. So I was going to mention that, but let me leave you with that and see if you have any questions.
This is Mary. I have one question back on the corn on the South America chart. It showed the export and use of corn, I believe it was.
Okay.
And it shows the quantity of corn grown is increasing pretty steadily. What are they doing internally? Are they increasing animal feed, or is it ethanol, or do you have any idea?
So yeah, so what this graph has got is the production. So the bars off is Brazilian production and Argentine production. Brazil being the blue and Argentina the red. So we can see how they've expanded production in both countries, but particularly in Brazil, as they've really increased their what they call the safrinha crop in Brazil, is that crop that they plant after soybeans. So yeah, this is pretty much addressing the production. Then the red line is the export. So if you look at the domestic consumption in those two countries, it's growing but pretty slowly. So a lot of that increased production is just going, to add to those that red line, which is the exports. So most of the growth in production is being exported out of the country. and it's, competition with us here in the United States. That answer your question?
Yes, it just kind of looked like maybe internally they were growing their own amount, but maybe it's kind of hard to tell on the bars.
Yeah, so there's not any domestic consumption graph on here. This is all just the production, and then the red line is their combined exports out of both countries. So you can see that red line's been growing pretty similar kind of rate as that the total production down there. So the domestic consumption is growing, but not nearly enough to handle all the increased production.
What else do we have?
I'll ask another one if nobody else is going to jump in there. What's the, I assume these numbers came out from USDA, I believe it was on Thursday or one day last week, whatever day it was.
Yeah, Thursday. Yeah.
I believe about that time or soon after we had the snowstorm up there in North Dakota, Nebraska, maybe even Minnesota. Is that going to, you think, affect things much?
Well, it has affected things. So, we had the market responded pretty negatively on the corn side, for example, to the report on Thursday. But then we snapped back sharply higher based on just what you mentioned with the blizzard in North Dakota. I mean, they're measuring that snowfall up there in feet. So it's pretty rough for North Dakota, and a lot of that crop is not mature yet. Plus, we've had freezing temperatures, pretty hard freeze across Iowa, at least northern third, or maybe half of Illinois, and now and some of that crop, I don't have the numbers in front of me, but some of that is not mature. So there's going to be some issues, with what the final production is going to look like in those areas, as well as the quality of the crop, given that freezing temperatures for a lot of that corn. It's not black layered. So and that's been in the market. So we saw a pretty big price response Friday, and then again yesterday to some extent. I think we pulled back a little bit today on prices, but the weather has been supportive to the market here the last few days.
Well, any other questions?
Well, one more thing on the weather front. I mean, so we've got the weather forecast is for things to be, relatively dry this week. So we've got should make some decent harvest progress this week. But then the forecast beyond this week is leaning quite a bit wetter. So we'll see, how that plays out through sort of the second half of the month. But right now, the forecast is probably not all that good for harvest.
The anecdotal feedback I have here in the state of Missouri on yields is that they've been kind of all over the place. I heard about some 80 bushel yields here, kind of central part of Missouri for soybeans, which were quite amazing. And I've heard some well over 200 bushel yields for corn, but then I've also heard some very, well, of course, there's been some zeros because some isn't going to get harvested, but there's also some very low yields being reported. So I know it seems to be getting a mixed response here in terms of what is happening actually out on the ground right now. So hopefully after this week, we may have a little better sense too, because it looks like they may be able to make some progress this week. Weather behaves. Other questions? Well, if we have no other questions, I would, we'll do this again in November. And I just wanted to, just so you're aware of the dates, November 8th is the release date. And so we should have our call on the 12th for our next update. And then December 12th will be the one after that. And if you have any thoughts or feedbacks on the format of this presentation, or if you think it should be done quarterly instead of monthly or whatever, let us know. We're always anxious to hear more feedback. And with that, thank you very much for attending this month's update, and we look forward to talking to you next month. Thank you.